The idea of investing was invented in 1980. Now, it wasn't invented for the kings and the queens who were collecting lands and castles, but it was invented for the masses, the other 99.9% of people, because before 1980, you did not need to know how to invest. And again, I'm setting aside the super rich people, but you didn't need to because you worked your whole life and then you finished working, you got a pension, and then you died. And if you were the spouse of that person that got the pension, you got the pension after they died. And even as recently as the 1960s, the life expectancy for a guy, a male, after he retired was 4 years. But it wasn't until 1980 when the 401k came around, which displaced the pension, that people, they didn't know it at the time, were pushed into this idea of having to learn how to protect and grow their money. Right? I mean, think about this. Before that, you had a pension and then you died. Well, we've got a problem today. It's not really a problem, but people are not dying at 65 years old. They're dying at 80 and 85. And the wealthier you are, the longer you're going to live. So you're going to actually need to learn how to protect and grow your money even after your income is gone. And that is a very new concept to humans. I mean, it's only about 36 years old. And so what bugs me is when I hear the industrial investment complex, whether that's a big box advisor, a boutique advisor, an independent advisor, or weekend workshop person, or a pick of the month newsletter person, they make this huge assumption that in our DNA, we've been investing for hundreds or thousands of years. And it's just not true. It is a very brand new concept to almost all of us. Again, except the super, super, super wealthy. And yet we're supposed to figure this out, and that scares us. So we go to the industrial investment complex. We go to the big box advisors, and they show us what they would do in a very complicated way, but it's not helping us. And so I want to point out the two biggest economic indicators to you today, and talk a little bit about why we have what we have. Hey everybody, this is RC Peck, and this is my 333rd episode to you, so pretty exciting about that. The theme for this weekend's episode is the two biggest economic indicators. And that is, and the two biggest economic indicators we have are these two guys. How do you get Bernie and Donnie where they are? Well, they're here because of the uncertainty of, say, the bottom 95% of people. There's a lot of uncertainty. And even those top 5 or 10% of people, they're not even getting ahead. Most of them are just treading water. They have not, maybe their net worth hasn't necessarily fallen, but it is just going right there, maybe barely with inflation. And so even for them, there's a lot of uncertainty. And so the two biggest economic indicators we have today are Bernie and Donnie. And that's telling us there's a lot of uncertainty. There's a lot of people saying, what the heck has happened the last 20 years? What is going on? I want to show you two more economic indicators, though they're price charts. The first one is the 10-year Treasury yield. This is a price chart going back 2.5 years. And as you can see, the red line on the screen is the 200-day exponential moving average, and it's falling over those 2.5 years. Well, when the yield falls on a bond, that means the price is going up. And the price is going up because people are paying more and more for that bond. And that's what's going on today, not just with the 10-year, but also with the 20-year and the 30-year. More and more money is going into bonds, partially because of boomers, partially because of concern, partially because of uncertainty. We are in uncertain times right now. And the 10-year Treasury yield chart, price chart, is showing us that. That's why it is not breaking above, or is it not breaking above yet? It's hanging out down here. Just like here we are in 2015, it came down here, but then came back up, and then it's right back down into its downtrend. So the 10-year Treasury is definitely telling us we are in uncertain times right now. Now, the other price chart I have for you is the S&P 500. And this is a 2-year price chart of the S&P, and the red line again is the 200-day exponential moving average. Now, big box advisors and the industrial investment complex and the pick of the month newsletters, they're just, first of all, the pick of the month newsletters, they're just going to give you another pick of the month this month, as they did last month and the last 22 months before that. All right, that's great. Great stories. Love the stories. But is it really helping you? I mean, ask yourself that honest question. Is it helping you? Most people, it's not. What the S&P 500 is telling us is it doesn't know. Now, it's near the top end of the range, so if it breaks out into the upside, it's not breaking out into the upside because things are cheap and there's deep value. It's breaking to the upside because there's like no other game in town. And it'll be interesting to see what happens if Janet Yellen and friends do add another 25 basis points in June. And if the market moves higher with that on the table, that does give some upward trajectory to the market. I mean, that is a kind of a bullish move. But here's the thing, you have to have a system. You have to have a strategy that knows what to do, knows when to get you in, knows when to get you out. Not day trading or week trading or month trading, but has the big picture and can eliminate the majority of the noise. And that's what uncertain times teach us the most, to have a system that can eliminate the noise. So what's the takeaway? The first takeaway is uncertainty itself is in a bull market. Uncertainty is in a bull market. And when things are uncertain, when people are uncertain, things get put on hold. And I'm willing to bet there's a lot of trades on hold right now until the November election. Is it going to be the liar or is it going to be the crazy man? Now, if it's the liar, she's a known. The crazy man is an unknown. So there'll be more volatility if the crazy man gets in than if the liar gets in. From a price chart point of view, of course. I'm not into politics. I study price charts. But we have uncertain times for sure between now and the November election. The other thing is there's a lot of financial PTSD around. Post-traumatic stress disorder around finances. And I'm not trying to be cutesy here. This is actually going on. I read and see and talk to a lot of people who have this financial PTSD. When people have that, they're not willing to make the same types of trades and bets. They go into things that have less volatility or what they perceive as less volatility. And so I think a lot of trades are on hold right now, and that's why we have the S&P 500 in this 24-month channel right now. And then lastly, we do have demographics in front of us. We do have 10,000 baby boomers retiring every day. And baby boomers retiring are going to have more money in bonds than the stock market. They're going to consume less, right? The biggest consumers really are the parents in their 40s and 50s who are raising kids and spending money on their kids. But man, once you're retired or you're a boomer, your kids are gone, they're out, and your spending slows down. And that's actually what we're seeing with the GDP. Spending is lowering. GDP growth is slowing. And so here's kind of the big takeaway. Have a system, have your approach, have your strategy, and make sure it can handle if the stock market moves up or if the stock market moves down. And what you want to do is be agnostic to what actually is happening. And that's what market probability and the long-term economic cycle strategy, LTEC and MPX, do. They're agnostic. They just want to be on the right side of the market. Thanks, guys, for being in my world. This is just another step in helping you protect your portfolio and your future. Until next time, this is RC Peck.